Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com. Over this past weekend we've had a lot of headlines dedicated to the Ukraine situation and Crimea voting on its referendum vote to join the Russian Federation and the implications that this could have for the markets. Now the big surprise through Monday's session was that we didn't really have a big drop off in risk trends. Now, this is certainly a fluid circumstance, and one that will hang around for a while, impacting these markets for a while, because the implications for the geopolitical situation will carry over into financial reciprocation of risk trends. But it doesn't necessarily have to set off immediately. All right, and this is something that I think is in the broader context very suitable for the kind of market conditions that we've seen for a long time. In other words, when we see something like the S&P 500, for example, you can see the pullbacks we've had throughout this period. All right, this only going back to less than a year. And you can see there have been periods of pullback, but subsequently they haven't necessarily turned into major reversals. They've, more importantly, turned out to be an opportunity, as we call it in trading, to buy the dip. All right. Buying the dip also has, and I've discussed this in previous strategy videos and trading videos, an implication of, or it's called something different, obviously, in some other markets. Namely, from one of the markets that I'm familiar with from my past is the options market. We call them vol sellers, all right, volatility sellers. And what we see in this volatility selling is, from options perspective, you have an inflated expectation of a particular outcome, and those expectations may be deemed too extreme. So seeing a pullback, and some traders start to position for the possibility that turns into a major reversal, but the likelihood of that being relatively low. Remember, going back to our discussions in the past about probability versus potential, a major reversal from something like the S&P 500 or risk sensitive like the yen crosses is high potential. If we do get that dedicated move to the downside, it can be quite aggressive, but at the same time it's a low probability because we have established very clear and straightforward trends. All right. So the vol sellers, or the dip buyers, like to take advantage of those expectations being overburdened, over exaggerated, and the bears overplaying their hand. So we still have a lot of these dip buying efforts and elements. We can see it not just in this type of price action, we can see it in the volatility readings themselves. So a good example is the S&P 500 versus the VIX index. Right? I use the VIX very often in the videos, and I think everyone should be pretty familiar with it. And as FX traders, we're also familiar with the health and the direction and the mobility of the global equity measures as well, because they're great measures of broader risk sentiment. But we can illustrate very clearly here the performance of the S&P 500 as a dip buying element, not necessarily a long-term trend element, and we'll show the difference between those two in just a second. But this is the volatility index, and when we see the market is concerned that there may be a massive reversal, a trend reversal, the vol sellers, or the dip buyers, will step in when they see that these expectations have been driven to too far of extremes. So when we flip this upside down, in fact, you can see it aligns very nicely to bottoms in the market because those dip buyers step in. Now, as I said, dip buying is not the same thing as long-term investment. All right. Long-term investment, after we see a substantial pullback, like the likes that we've seen, let's say back in 2008, all right, or even in 2011, when we've had substantial pullback, and investors might see that as a good opportunity after basing to get in for the long haul. That is one aspect. That is dedicated and longer-term investment. What we're seeing is more along the lines of short-term speculative advantage taking in these short-term corrections that have been brought about by excessive momentum. Right? And as we can see in momentum themselves, however, the pullbacks are becoming of lesser strength. The taking advantage, the buying of the dips, they are also becoming a little bit less, with time, aggressive. So traders are taking advantage of those pullbacks, but they are getting out pretty quickly. They're not leading it into a new and aggressive trend. They are letting them die out quickly, knowing that the extent of the move is likely to be that pullback. All right, those vol sellers are not in it for the long term. They're not in it for very aggressive returns. They are in it for the quick turnaround. All right, that's a very different type of approach in the markets. And this isn't just with risk trends, although it is most prominent with risk trends, but we've also seen it take effect in other currency pairs, like the EURUSD, for example. When we look at the EURUSD, we can see that there have been some pullbacks, but in the constraints of a larger rising wedge pattern. And most of the price action of the recent past has been pullbacks, and those pullbacks have not really been able to generate meaningful reversal. All right, the market has just defaulted with a steady and quiet push forward. Now, this is in part due to the appeal of a pullback in excessive expectations for the FX market. This is the EURUSD in the dark blue versus the FX volatility measures. The red is short term, the light blue is medium term. We'll take out the medium term just so we can concentrate on this short term vol. But as you can see, there's been spikes in this volatility measure. And with those spikes, we've seen the markets attempt to take opportunity with the EURUSD. All right. Now, the appeal for the euro is not necessarily it's a risk currency, but it has a underlying momentum to it, and that defers to something else completely, which is the expectations that the ECB continues to see diversification flows. Now, this is not necessarily speculative related. It's major central banks or institutions that had previously written the euro off and were very concerned about the euro because of its financial uncertainties and the eurozone crisis, where we presume that there was a good probability that you could lose one of the members there. With that receding, you see a lot of that capital flowing back in that was initially taken out, the flight of capital. All right, this provides a dominant fundamental trend that is edging this currency pair higher, and we see that those volatility pickups for the EURUSD individually or with the FX market in general are seen as good opportunities to buy the dip. All right? But it's that underlying fundamental theme that keeps this trend in motion, because otherwise that volatility pickup wouldn't necessarily play out very well here, because this is not necessarily a risk-on, risk-off kind of currency pair. The same kind of mentality is given to the pound dollar, which we've seen a pretty steady trend since July of this past year. And this too, when we look at the risk severity curve that I've been referencing pretty regularly in the videos, the EURUSD and the pound USD are not readily susceptible to risk-on, risk-off flows. These are pairs that are much more liquid, and they don't really carry a high risk versus a full liquidity, although the US dollar is still the liquidity currency. You don't pair it with the high risk currency pair or a currency. And that helps mute the response that we get to risk on, risk off. But what we have is a prevailing trend. All right, with the EURUSD, it was fundamental. With the pound dollar, similar fundamental theme, but the trend itself is much more consistent on a technical basis, and you can see how the dip buying is taking advantage of. All right, the vol sellers see that we have a pullback in the pound dollar, maybe on the expectations that risk can become unwieldy, and the US dollar may all of a sudden regain a lot of its safe haven appeal, which has been spurned as of late over the past months, because we really haven't had that really strong risk push. But when those expectations of dollar gains because of volatility rise start to fade off a little bit, all right, the dollar is seen as being overdone, and subsequently there's dip buying on something like the pound dollar, because you have that consistent trend, you have technical levels, and you have the expectations that have been overwrought for the US dollar. So once again, when we flip this upside down, the volatility measures, you can see that the short-term volatility is an opportunity for many to buy that dip. All right? So buying the dip or selling volatility, is in the option markets, they say that's what the professionals do. And that happens because it's a probability game. All right? They're going with the high probability, not necessarily the high potential. Now, we bring this back into our own trading when we recognize that, yes, there is a very dramatic skew in terms of what the potential is if I'm talking about a risk-on versus a risk-off theme. Clearly at record highs for the S&P 500 against the kind of market condition backdrop that we have, risk aversion could come with aggressive momentum to the downside. But it's a lower probability because, as we've seen for the past 5 years, it is the dominant trend to the upside. All right? We can also see that shorter-lived term trends, like the euro dollar and pound dollar, are consistent and thereby draw the higher probability. But there's asymmetrical opportunity going forward. The potential is that the EURUSD reversing because the ECB makes a threat against the euro rising, or that the Fed's taper maybe later this week can generate more gains for the US dollar, or risk aversion is great enough that it can overwhelm or override the fundamental holdup that this currency pair has to that theme. But the potential is, the trend is the higher probability. The potential is more to the downside, but we have to balance those two out. All right? So in terms of how we apply trading strategy to this, we go with the prevailing trends. We wait to see clear and decisive technical breaks and fundamental moves to support a counter trend view. All right, so if it were something on the EURUSD, I'd want to see something like a break back below 138, 138.50, and I'd want to see something where the euro has a definitive reason to sell off. Risk trends really wouldn't come into very substantial play in this particular pair. Pound dollar, I'd want to see not just the 166 drop, I want to see the 165 drop, and I want to see interest rate expectations for the Bank of England to diminish, especially relative to the Federal Reserve outlook. All right? And of course, from risk trends, I want to see the bigger trend lines break. I want to see this more of a universal pattern, not just something isolated to the S&P 500. Even though it's a great benchmark for risk trends, it is not the be-all, end-all of the overall sentiment measure itself. We have to see the fundamentals. All right? So in terms of trading, we want to go with the probabilities, but we want to respect the potential. Once we see enough evidence that the markets are turning to the greater potential outcomes, then we can take advantage. But we have to be careful trying to fight the major trend until those changes, those shifts, are clear. Keep your eyes on the headlines. There's certainly a lot of event risk still going ahead, and they can stir the pot, so to speak, on these bigger themes and maybe give us that drive. But remember, the people that are buying the dip or selling volatility are always going to be there in status quo. Good luck trading out there, guys, and we'll do our next strategy video tomorrow.